Good afternoon and welcome to today's webinar, Strengthening Your Financial Future in These Uncertain Times. Today, Krista Kerr and Frank Satina will provide a market update, taking into account current market conditions, including an update on the recent banking challenges. At the end of the presentation, we will save some time for your questions. Just a quick reminder before we begin, you'll notice at the bottom of your screens, there's a Q&A icon in your toolbar. You can click on this icon to type in your questions throughout the presentation. We will be accumulating them throughout, and we will answer them all at the end in the Q&A section with our panelists. I wanted to begin in honor of Krista Kerr's recent 30th anniversary working at Kerr Financial, which was actually earlier this week. I'm just sharing a picture from her early days at Kerr Financial. I think actually she hasn't changed that much. This is a picture of her and Rob. Congratulations, Krista. What a significant milestone. And although Krista may have started working here in 1993, the firm actually already had been around for 14 years, as Rob, her father, started the firm back in 1979. He started the company because he really wanted to help individuals become more businesslike about their personal finances. Surprisingly, back in 1979, individuals really had no single place to look to for financial help with their investments, their tax, their financial planning, and he felt individuals are missing out on their opportunities to save taxes, cut costs, and get better investment returns. So today, Kerr Financial works with Canadian families, providing integrated investment management services, which include investment management, financial planning, accounting, and family governance, all under one roof. We are also a discretionary portfolio manager with fiduciary duty to act in the best interest of our clients. Our strategy is following a disciplined focus on long-term investment objectives that yield the benefits of building and sustaining wealth. We believe in the importance of diversification across asset classes, geographies, sectors, and companies, and we follow an approach of building multi-manager portfolios through selecting best-in-class investment managers with diverse yet complementary investment styles. Krista is our first speaker today. She's the CEO of Kerr Financial, and she's responsible for the overall management and leadership of our firm. She's an active member of the firm's investment committee. She leads our multifamily office division, which provides integrated services to support our high net worth families with multi-generational wealth stewardship. She's also a thought leader in the Canadian personal finance industry, and she's appeared frequently on TV, radio, newspapers, addressing various planning and investment topics. And Frank is coming today as well, and he's responsible for our investment management group in Montreal. He started his career at Tal Investment over 20 years ago, and prior to Kerr Financial, he spent 15 years as an equity analyst helping portfolio managers in security selection as a VP of Canadian Equities. Frank is a CFA and a graduate of the John Molson School of Business. So after a very challenging 2022, and as we end the first quarter and look ahead to summer, although there have been some notable improvements, there continue to be challenges for investors. And Krista has turned on her video and mic, and I'll ask her to begin the presentation. Thanks, Krista.
Perfect. Thank you. Good afternoon, everybody. You're seeing lots of images of me over the years. I can see through the early days to earlier business pictures and then the real thing in person now. So nice to see you all. Nice to see some spring flowers on the screen. I know it's turned a little bit cold in Montreal and Toronto, but let's hope we get back to conditions like last week. And that's a little bit what we've seen in markets that, we had beautiful weather last week, colder weather this week. We've seen that kind of up and down in the markets in the first quarter. So we're going to talk a little bit about the what happened in Q1 and what data is coming out now and what that means for the rest of the year, and then how we see that playing out in portfolios. So we wanted to start with a little question to you. After a difficult 2022, we saw some good returns in the first quarter. Given where we are now, what's your outlook for the rest of the year? And we will be addressing, of course, our thoughts on this side, but we wanted to ask you for your opinion about whether you're optimistic going forward or neutral or pessimistic given what you're hearing. So just interested in your point of view. And once we get the results, I'll read them out because I know in the playback, the polling answers don't show up. So we'll give you a minute to answer that. Interesting. So we have people grouping around the middle. Nobody's feeling either very optimistic or very pessimistic, but for the playback audience, we've got quite an even split. About 38% of respondents saying they feel optimistic about the balance of the year, 38%, the same amount being neutral, and 24% feeling a bit pessimistic. And I can understand reasons for feeling all of those things because, as I said, we've seen lots of up and downs in the market. Why don't we start looking at what happened in the quarter, and then we will address those ups and downs and what they mean, and we'll come back to our outlook for things. So the first quarter, if you closed your eyes and didn't watch any financial news and didn't look at your statements through the period and didn't really pay attention to the markets, but saw this result coming out of it, you'd feel pretty good about the first quarter and saying that everything was quite positive after a difficult 2022. And we don't need to worry about anything. And there isn't all this uncertainty out there. In fact, what we'll see as we go through this, there was a real up and down rocky road to sort of get to this positive result. But the headline, first of all, to start, is that we did have quite a positive first quarter of returns in all asset classes after having had a difficult 2022. So if you look at the blue graph, the one on the far left side for each of these asset classes, that's what happened between January and March of 2023. In terms of cash, as most of you know, we've seen better returns on cash lately. So in the first quarter, if you were all in cash or GICs, you would have had about a 1.1% return. That's on target for just over 4% annual rate of return on cash and GICs. So that would have been a low risk way to get a return, but you'll see that other asset classes had better returns and more recovery after the difficult 2022 market period. Bonds had quite a bit of volatility in the period as people kept probably over extrapolating what was happening with central banks and rate increases and when they might pivot from that. But at the end of the quarter, we were up 3.2% in the Canadian bond market, which was nice to see. All stock markets were also positive, with the Canadian market being up 4.6%. And you might remember we were down a little bit less than some markets last year because we had energy in our stock market. So we were up a little bit less maybe than other markets in the first quarter, but still positive 4.6%. The US was up 7.4% for the quarter. And foreign markets fared quite well, with the international equity markets, EFI market up 8.5%. Emerging markets had very positive start to the quarter because of China reopening, but then had some volatility within it. So ended about 3.9% positive on the quarter. And all of that rolled up to having positive returns in balanced portfolios of about 4.6% if we look at our balanced benchmark. So again, quite a nice quarter, especially after a difficult 2022. But these positive returns don't really show us what happened, which you would have felt if you were watching headlines in your portfolios month to month. The next slide will help us remember that. I don't know if we want to remember that, but you'll see here that there was a lot of volatility. This is just a graph that simply maps the S&P 500, and you can see the blue line was a nice positive straight up line for the month of January. So in January, we saw a really positive response. That was after a difficult 2022, and there were sort of three things that contributed to that. First of all, we saw signs of inflation abating, which was nice. Inflation was coming off a little bit. People started being hopeful that that might signal the end of rate hikes. We also had China reopening, which was nice additional activity, although people wondered if that would fuel more inflation, but that was positive. And then Europe avoided some more difficulty that people anticipated because they had an unseasonably warm weather pattern. So they didn't need as much reliance on energy, which people were worried about because of scarcity and the war in the Ukraine. So very positive January. Everyone felt really good about that. In February, people started worrying that that positive news was actually going to make the central banks dig in more and have to continue raising rates, that was going to fuel more inflation. In fact, this positive economic activity with China reopening and other things was going to be positive, and the central banks would have to dig in and continue with their rate hikes, which they actually did a little bit, which we'll talk about. So you saw markets come off in the month of February. Then in March, we started out feeling okay. And on March 9th, we had Silicon Valley Bank collapse. And that was really, we'll spend a bit of time on that. I know you've probably heard a lot about that, but that was a sign of a stress in the regional banking system. That was really there was some idiosyncratic reasons behind Silicon Valley Bank itself, but it did give a reflection of that aggressive rate hike from last year really having an impact on the economy. So we started March okay. We had that big drop down when people were worried about the regional banking system in the US and then the global banking system, global financial system, and whether there would be concerns there. Then regulators stepped in and really took measures to stabilize markets and take away that fear. And people started digesting that regional banking crisis and sort of concluding that there wasn't going to be contagion across the whole global banking system. So the market then stabilized and ended up okay in March. So this is all behind the scenes as we got to those nice equity returns that we saw on the first slide. But there was quite a lot of up and down, which caused some uncertainties. And I think part of that is there's new economic data coming out every day. People are sort of extrapolating what that means, and that's causing volatility in the markets. And we're likely to see some of that continue for the rest of the year. The other thing we saw this year, and we'll look at it in two slides here, is it was quite a reversal of fortunes from what we saw in 2022. So in 2022, you might remember, technology stocks and communication services were really hit hard and were the worst performers in the year in 2022. In the current quarter, as people felt more confident and there was more feeling that things were getting back on the right track, those two sectors came back strong and they were the most positive performers in the quarter. So people sort of rotated back into those tech stocks. And conversely, the stocks that had held up the best in 2022, being energy and the defensive stocks, utilities, healthcares, those stocks all really lagged. You'll see those being the lower performers in the quarter. So a real change in that. And that's partially because they had held up well before. And then the financials, unsurprisingly, after we talk a little bit about the banking crisis, was the sector that was the hardest hit, especially this is a US sector return graph. So in the US, all banking stocks were pulled down a little bit with that banking crisis. So the reasons for some of this, people started feeling more confident at the beginning of the quarter that inflation was abating, the economy was holding up better. That meant we had more confidence in some of the growthier sectors. There was also the feeling that the federal banks might start getting closer to either a pause or a pivot on rate hikes. And if we see interest rates coming down a bit, there's less of a discount to those growth types of stocks. So all of those things played into the way sectors performed, and it really was kind of an inverse to what we saw last year. The same is true on the next slide when we think about the style contribution. So last year, you might remember that we talked about value stocks and dividend stocks, the more defensive stocks being the ones that really held up the best. As we moved into this first quarter, where people started feeling we were turning the corner and getting closer to the end of rate hikes, it was really the quality growth stocks that did the best, and the defensive, more dividend-bearing value stocks lagged a little bit. They were still positive, but they lagged a bit. So part of the reason that in our portfolios, we like to have that diversification of styles. So we get contribution from different styles, and also reflecting the fact that the quality growth stocks had really been beaten down in 2022, and they started coming back as people gained a bit of confidence. So that's sort of a backdrop to what we saw in the markets in that period. I think if we go further, we'll just pause for a moment on the regional banking crisis. I know you will have heard a lot about that. We put something out and a lot of others did. But Silicon Valley Bank was the first sort of shoe to drop on March 9th, as we said, when we saw the impact of some of the aggressive rate hikes. There was one of our colleagues here who's an economist, says that economists say that the time when there'll be a change in a federal rate hiking cycle is when something breaks. So, in some ways, this banking crisis could be seen as a first big crack in the system. And maybe that does support the fact that we're getting closer to the end of this rate hiking cycle. But basically with Silicon Valley Bank and all the banks, there was a huge amount of increases in interest rates in the prior year. For various reasons that I'll explain briefly in a second. They took a lot of losses on some long bonds they had in their portfolio, which relates to sort of the interest rate cycle. And that put them in a position where depositors started panicking, pulling out deposits, and put them in a position where the bank failed. So really, this, as I'm sure all of you are aware, is a bit of an idiosyncratic situation. So Silicon Valley Bank had a very big concentration in venture capital clients who were depositors, so people in the technology and healthcare VC space. These are people that had done a lot of capital raises and had big deposits at the bank. So Silicon Valley Bank had seen a very big, rapid increase in deposits. Those deposits are, in fact, short-term liabilities of the bank because they have to pay those out to the clients as the clients need them. And those VC-type companies had a big appetite for needing cash. So they were needing that cash that was on deposit. Silicon Valley Bank had matched some of those to a greater degree than other banks with longer bonds instead of having short-term bonds matching. And those long bonds experienced some losses when they had to sell to satisfy the depositors. So I think there were some management missteps in this situation, and it was much more concentrated situation in this bank than in other banks. But that collapse was the first issue that people saw. Then there was a fear that that was going to spread across other regional banks with Signature Bank and First Republic Bank in New York. And then we had sort of separately, but brought into the same umbrella, the fact that Credit Suisse, which had been struggling for some time, really had their shares plummet and was then taken over by UBS, sort of coordinated by the Swiss government. So there was this big fear about, was this going to be a real sign of stress in the global financial system? Were we going to have a problem with supporting activity in the economy? And as you saw in that graph of the S&P, we saw a real drop down in markets initially in March, but regulators stepped in quickly to balance things out. And I think by the end of the day, we all felt that this was more of a crisis of certain banks instead of a crisis across the banking industry. So I think if you go to the next slide, there's two thoughts coming out of that. First of all, I think we, like many others, feel that there's a low risk of that being a contagion across all regional banks or all banks overall. The federal regulators did act swiftly. They have a number of strategies now, including some funding processes that can help provide liquidity. So they acted swiftly, they acted decisively. That helped stabilize the markets and the banking sector. We also have very different conditions than we had in the great financial crisis at the end of, in 2008, et cetera. And that's the fundamentals in the banks are better. The banks are better regulated and better capitalized, and they generally have better asset quality. So we're not in the same position as we were then. Things are stronger. And I think really Silicon Valley Bank, for the reasons we discussed, was a very specific case. And that doesn't necessarily mean fear for the rest of the sector. However, as we show on the right-hand side, this crisis and the impact of the great increase in rates last year will have an impact on the economy going forward. I think it's important to understand that credit conditions are tighter. It's going to be harder for people to get loans because banks are going to be more cautious and have to watch their capital requirements. That may slow things down, so that possibly increases the chance of recession for the balance of this year, and we'll talk about that in a minute. The other sector to really watch is the commercial real estate sector. It's said that about 70% of loans to the commercial real estate sector in the US came out of the regional banking or come out of the regional banking sector rather than the big banks. And I know a lot of clients have shifted to the big banks and still have access to capital, but we have to have a look at the commercial real estate sector and see, make sure we feel comfortable with the positions there. And this whole situation further complicates the central banks and how they're going to look at interest rates. And we'll talk about that again, but they've really got different implications. They've got, economic data, they've got inflation, and now they have financial stability really to consider and focus on with their rate policy. So things are complicated and uncertainty continues, but we don't believe there's going to be a major failure in any bank. So we don't feel a big fear on that side, but there is some uncertainty coming out of it that'll impact things. So I think the big thing people are watching, the big story is sort of inflation. Where are we at in terms of inflation, and what does that mean in terms of central banks? The volatility we see in the markets, a lot of it is people making bets on when the central banks are going to actually pivot their banking, their interest rate policies, and when they're going to start to cut rates. So as we see data showing inflation going down, which we saw yesterday with CPI numbers, that makes people feel hopeful that we're getting closer to the end of rate hikes. On the other hand, things like that tightness in financial lending make us concerned that it could continue. So if we just sort of remember what happens here, the central banks and certainly the Federal Reserve in the US specifically has a dual mandate. So with their rate setting policy, they are looking to, number one, keep prices stable, which is manage inflation. But they're also trying to maximize employment or get us as close to full employment as possible, which means keep the economy going. So they have two different objectives that they're looking at. Last year, as we all know, this is not news to us, they aggressively raised hikes. We started at almost a 0% interest rate at the beginning of 2022, 0.25% in the US. And they actually had several rate increases in the year to end up at 4.5% by the end of the year. So a massive increase in rate hikes in order to fight inflation. And inflation had started because we came out of COVID and people started spending, but also largely because we'd had very easy monetary and fiscal policy for a long time. So there was a lot of money in the system. So a number of reasons that inflation crept up. And last year they acted very decisively to try and fight inflation by raising rates. So far this year in the US, we've seen two further rate hikes of 25 basis points each. So we're at about 5% on the Fed rate in March. Where they go from here, there is a bit of a balancing act, as we mentioned. So we want to think about, do they need to increase rates to keep fighting inflation? And if you looked at news this morning, the UK came out with a 10% inflation print for March. So they still have work to do to manage inflation. In Canada, we came out at 4.6%. So that was much better than it had been before. So there's a question about how far do we still need to go to fight inflation? And on the other hand, if we're going to see some weakness in economic growth and we're going to see some tightness on lending, is that going to really slow things down too much to the point where we might see an impact on employment? And therefore, do they need to start decreasing rates? Or are they going to take what the Bank of Canada approach is now and say, we're going to pause for the moment and keep an eye on data and then move later on? So I think, again, we've got, this whole story of contrary or opposing forces that we're seeing in the markets. On the one hand, since the beginning of the year, we're seeing the economy hold up better than expected. So that means that maybe the inflation fight isn't completely over. On the other hand, we are seeing inflation abate. So we're seeing it come down. It's not down to the target, the 2% target that the central banks want to see, but it is coming down. And now we have to make sure that there isn't a fear in the global banking system. So we want to see stability. I think to date, the central banks are doing a decent job. They're really following economic data as it comes out. As we mentioned, Canada has sort of said they're going to pause on rate hikes for a while. And I think this comes up in a future slide, but the US is sort of going slowly with small hikes. I think we're definitely coming closer to the end, but let's digest this a bit further by looking at inflation and rate hikes. So inflation I think what we're seeing, the big story in inflation is that we're seeing it moderate. Inflation is coming down, but it's gradually coming down. So the report that came out yesterday in Canada was that CPI was down to 4.3. Sorry, I said 4.6, but 4.3% in March. Now, part of that is because March of 2021, we were at pretty high levels still coming off the pandemic. So part of it is a base effect. The other thing is a big impact of lower energy prices at the beginning of the year. So those two things help to contribute to that. But we are seeing inflation come off. If you think about that fourth bullet point at the top, some of the main reasons that we saw the big inflation through last year are reversing. So commodity prices are calming, supply chain problems are resolved, and inventories are higher, and that monetary and fiscal stimulus has really been brought down as central banks have had to address this issue. So some of those initial drivers are calming down, but we're also seeing some positive movement from the other points up there. So shelter inflation, the cost of rent and homes is coming down a little bit, even as mortgage interest rates are going up, but shelter inflation is coming down. And then wage pressures are coming off a little bit and demand growth is coming off. So all of those are helping us in terms of outlook for inflation. If you look at our components that we've looked at in prior calls before, goods inflation, we're really seeing that resolution of the supply chain. So that's actually maybe even a little bit disinflationary now. That's not a problem. Services, people have said, so travel costs, et cetera, people have expected to be higher. Now, service inflation wasn't as high as people thought in the March numbers. So but I think generally it's been one of the ones that's been holding up a little bit higher. Housing or shelter, as I mentioned, we're starting to see the pace of rent increases come off. So that is decelerating a little bit. Wages, we still have pretty strong employment, but we are seeing wage increases come off. So that's moving in the right direction. Energy prices, certainly in the first quarter, were down, and that was a big impact on reducing the inflation rate to March. We did see a little bit higher prices now, but I think if we think we're going to see some slowing growth, maybe that won't continue, something to keep an eye on. Food prices are still high. I mean, that's a big impact on the UK inflation numbers that came out today, and we're still seeing a high rate, but it is a little bit less than it was in February. So these things are moving in the right direction. I think some people feel after the numbers we saw, the 4.3 for March, that we might get to 3% inflation by the end of this year in Canada, and then move towards that 2% next year. So moving in the right direction on inflation, I think. And all of that is sort of coming together on the next slide to sort of look at the fact that we are coming closer to the end of the rate hiking cycle that we've seen. So inflation is moderating. We do see those tighter lending conditions, which makes the bank a little bit more concerned about how much the economy is going to grow. So we think we'll be closer to the end of rate hikes. Some people are feeling in the US that you might see another 25 basis point increase coming up. And then Canada sort of signaled that they're pausing for the moment and watching the data. So I think we're getting closer to that. My personal feeling is that the banks really won't want to start cutting rates too soon and then have to go the other way. So I personally feel we may not see rate cuts coming until the beginning of next year. I think we can see some pausing, and if things change and the conditions get even tighter and the economy falters, we'll see something faster. But my personal view is that I think we'll see rates start to come down into next year. I think one of the things we need to remember, though, is we may not go back to virtually zero interest rates and zero, less than 2% inflation in a normal course. It might be a little bit higher than that going forward, and that would still be okay. So one of the things to keep in mind. I think with all that we're seeing, and with particularly the tighter lending conditions, I think recession continues to be something we might see this year. The market's actually pricing that in. So on the one hand, the economy is holding up better than we thought, which means recession wouldn't be as likely. But then we have this tighter financial conditions that could pull us the other way. I think just to pause on the next two slides, one of the impacts of that regional banking crisis is depositors pulled out $185 billion in deposits from the banks. Now, some of them moved to the big banks, but if you look at that and say that leverage ratios are that they have to keep 7 to 10% assets to allow them to do the lending that they're doing, that would be a reduction of about 1.85 to 2.65 trillion in loans in the system. So that speaks to the fact that as banks get more concerned about lending, that reduces the money available to companies to borrow. Now, there are some bonds still coming out with great rates. I think there was an LVMH issue today that was better than people expected. So it's not like people can't borrow, but we just have to be aware that there's tighter conditions. I think on balance, we still have a sort of possibly slightly better than average or average possibility of seeing recession this year. Goldman Sachs has been talking about a 40 to 55% chance of recession in 2023, and they're tipping to the higher end of that based on what they're seeing in the economy right now. Even if we see that, though, our feeling is that recession wouldn't be a deep one. You know, balance sheets are still strong. There's cash on hand in companies. Labor markets are still holding up, even though we're seeing some layoffs now. So we wouldn't anticipate a recession to be a deep one. And then I think if we think about what that means, you know, most importantly, as you think about that, you know, some people would say, if I see a recession, does that mean my portfolio is going to go down drastically in value? And I would say, no, that doesn't, you know, a recession doesn't necessarily equate with negative equity market returns. We are seeing that markets have priced in some likelihood of a recession. So that's already been reflected in market numbers. And also markets are forward looking. So if we experience some recession still the latter half of this year, but we're starting to come out of it at the end of the year or likely to come out of it early next year, markets are forward looking and will already be pricing that increase back in. So that doesn't necessarily make us worry about market returns. There are still people feeling fairly positive. You know, Goldman is still holding to their base case that they think US returns might be 13% by the end of the year, which we're sort of just over halfway there with 7.4% at the beginning of the year. But that's basically based on some earnings growth and profit margins sort of normalizing these supply chain issues. But we do believe that there's some caution. So back to that, you know, we feel sort of the same way you do a little bit in terms of outlook. We feel there are some reasons to be positive, but there's also some reasons to be cautious. So because of the tighter lending conditions, we're watching earnings reports very closely, and we think there could be some economic weakness mid-year, and we know waiting to see what the impact of higher costs that companies are facing will do to their earnings. And interest rates, as I mentioned, I don't think they're going to start coming down till the beginning of next year. So those are reasons we might have a little bit of caution. Now, that doesn't mean that we're worried about being invested, but it does mean that we want to be cautious, stick with quality, and know that if we're patient, we're going to do well in the portfolios. But you'll see in our positioning that we want to be, sort of balanced in how we're moving forward. So again, just to signal the summary of where we see, again, there's positive and items that cause us to be a little bit cautious. So the positive signs, the consumer is still really healthy. We still have some savings. There are some studies that say people are using up their savings and may not have them too much beyond the rest of the year, but the consumer is strong. People still have jobs. The supply chain, as we mentioned, is doing well. Companies have strong balance sheets, and inflation is showing signs of coming off. So this is all moving in the right direction. We feel good about these. And then just to summarize the risks, there are still some risks. So as we talked about, we think there may be some weaker economic growth ahead. We want to keep an eye on earnings from companies as we see the impact of the input costs that they have, the inflation they're facing. We think lending could be tighter, so we want to be careful with investing in companies with good quality and good balance sheets. And then we think inflation and interest rates may not come down to those near zero levels that we saw in the past, so that could be something we have to watch for. And then the big, three other unknowns that we don't know is, geopolitical tensions. We still have the awful war in Ukraine. We still have China-US tensions. We still have issues in Iran and North Korea. And so we need to keep an eye on all of those. And we need to keep an eye on cybersecurity. Those are things that are hard to quantify, but they still cause us to be a little bit cautious. So I think on balance, we feel good about a lot of things, but we also feel some caution. And that means, if you go to the next slide, we're sort of looking at portfolios with a little bit of a cautious eye, but feeling cautiously optimistic. So we are continuing to hold a little bit more cash in portfolios where people need need income coming up. To the people who say, well, shouldn't I just be all in GICs? I don't want the risk. You can see from those initial numbers we looked at that the balanced portfolio did have a better recovery than the GICs did. So you're catching up a bit more if you're invested and staying invested, but you are getting paid to keep some cash on hand. And if you are going to need it, and we know there's going to be some volatility, it's nice to have a bit more cash in the portfolio. So we're doing that strategically based on each portfolio's needs. We want to stay diversified, and that's again because we see the positives, but we also see some uncertainties. So we want to keep that diversification. And as Frank's going to talk a little bit more about, we want to focus on quality. So we want to have high quality bonds in the portfolio, and we want to focus on companies that are well capitalized, they have strong balance sheets, and they have the ability to grow. So those sort of quality growth types of companies. We still find reasons to have some alternative asset classes in the portfolio, and Frank will talk a little bit about some opportunities there. And then we want to remember the same things that we've mentioned on the other calls. So the economy does move in cycles. This is normal. We're starting to see some recovery. This is good, but stick with your long-term plan. Make sure the portfolio is aligned with your risk capacity and willingness and makes sense for your objectives. And then we're starting to think about what are those long-term opportunities going forward. So there's opportunities in infrastructure. If you think of the Build Back Better campaign in the US, and in Europe, the real push to have more green infrastructure to support their net zero policies. So those are opportunities. The restructuring of supply chains, more nearshoring and onshoring create some opportunities. The eventual transition, this doesn't mean there's no room still for regular energy, but eventually we're going to see much more of a transition to a green economy. So those are all things that we want to position for longer term. We want to stay cautious, stay diversified, keep quality in the portfolio, and then start thinking about those opportunities going forward. So I think from here, I'll let Frank take it on to some of the next things that we're going to look at in portfolios, and then we'll be happy to take your questions. Thanks.
Thank you, Krista. That was a good update. We have 3 insights we want to share with you today. We think all investors should be mindful of these topics, though we recognize that each of the topics has a different investment time horizon. We'll start by touching on why investors need to remain vigilant in how they position their equity portfolios, and why we believe the quality factor is attractive in the current environment. We'll then discuss why investors should be attentive to strategies such as high yield and private credit, as they may provide opportunities if markets experience more turmoil in the upcoming quarters. And lastly, we'll touch on a longer-term view of the emergence of artificial intelligence innovation and the potential impacts it may have on the global economy and financial markets. So let's move to our first topic. And as Crystal's highlighted, though markets have staged a recovery over the last 6 months, we continue to emphasize the need to maintain a cautious stance. We believe there are risks tied to economic growth, inflation, and interest rates that could impact asset values in the short term. As it pertains to equity portfolios, we do note an ongoing level of volatility between different factors. And you'll notice this by observing this table that illustrates the calendar returns for the different global equity factors within the MSCI indices. You'll note that there's a fairly wide divergence in the returns from the different factors in each period. And it's extremely difficult to pinpoint what factors will perform best in any one period. And this is far more complicated today with so much uncertainty on a number of different issues. So if we look at this table here, the MSCI Growth Index that's represented by companies that are growing revenues and earnings at a fast pace really outperformed the overall market in 2019 and 2020, but was a lagging factor last year. In contrast, if you look at the Global Value Factor that's represented by companies that have lower valuations, it struggled in 2020, but managed to really outperform in the last 2 calendar years. So for these reasons, we continue to believe that investors stand to benefit from a multi-manager approach. This ensures equity portfolios have exposure to a diverse set of equity factors, and it provides investors with another level of diversification that reduces the volatility of investment returns. Now, if we take a closer look at equity fundamentals, we have a preference to maintain a greater exposure to the quality factor. As we expect, companies with a higher quality score will outperform if economic growth deteriorates and financial conditions become more challenging. So if we move to our next chart, which kind of captures equity valuations both in the US and globally over the last 3 decades, you'll notice that in the last 18 months, there has been a contraction in multiples. So for the US, for example, multiples peaked at 24 times late in 2021, but are now closer to 18 times. So although equity markets today are not as severely overvalued relative to history, some would argue that multiples do have some downside risk in a scenario where we have sluggish earnings growth and interest rates continue to move higher. I think beyond valuation, when we look at earnings, corporate earnings, we still see that they're vulnerable to weaker demand and margins due to inflationary pressures. We have noted that revenue and earnings expectations did trend lower in the first quarter, as analysts are now expecting very modest 2% growth in S&P revenues in 2023. If we move to the next chart, this illustrates that profit margins did decline over the last 18 months, but overall margins still remain quite elevated relative to where they were just a few years ago. We would also note that in periods where we had recessions, you notice that there's a very brief but pretty significant decline in margins. So for this reason, we believe investors should favor the quality factor within equity portfolios. And if you look at the next slide, the quality factor is really, it's represented by companies that have demonstrated a track record of earning high returns on equity, have stable earnings growth, and typically have high margins and do generate excess free cash flow, all while maintaining a fairly low level of financial leverage. This chart here illustrates the sector allocation of the MSCI Quality Index, and it compares it to the overall MSCI World Index. And what you'll notice is that the Quality Index has very little exposure to cyclical sectors, such as energy and materials, sectors that are known to have less predictable pricing dynamics. So we suspect, in an environment where we have greater volatility and there is a growing list of unknowns tied to interest rates, supply chains, and growth rates, investors will show a greater appreciation for owning higher quality companies that can adapt to a different market scenario. So, for example, if we have interest rates that are continue to kind of move higher and the cost of debt becomes a little more burdensome for corporations, a higher quality company that has very little debt will have an advantage versus its peers as more of those revenues are converted to earnings. Likewise, a higher quality company that can sustain profitability during a period of weaker economic growth can take advantage of the downturn by using excess cash flow to invest in new projects or make acquisitions. Whereas a lower quality, less profitable peer kind of moves into defensive mode as they focus on maintaining market share or reducing costs. Therefore, although we continue to see the benefits in a multi-manager approach, in the current environment, we do favor a larger allocation to the quality factor, given the potential challenging environment for revenues and earnings in the upcoming quarters. Now, our second insight ties into the credit markets, and more specifically, the potential opportunities that could arise in credit strategies focused on high yield and private credit. In short, we've not seen a great deal of distress in credit markets. But if we do enter a more challenging environment for corporations, we believe that with astute credit analysis and strong underwriting, it could provide investors with pretty attractive risk-return opportunities. This chart highlights the relative calm in U.S. high-yield markets. Despite the material increase in interest rates, we note that credit spreads have not widened a great deal. So the U.S. high-yield index spread is at 4.75%. That is actually at the long-term historical median for credit spreads. That 4.75% spread is the incremental return investors are now earning by owning bonds of companies that have a higher risk of default. You'll notice that in periods where we do have economic or financial stress like 2000 or 2008 or the early months of the pandemic, credit spreads widen quite significantly. Now, the next chart highlights that we are seeing some early signs of distress. There were 183 companies in the US in the S&P Global Market Universe that declared bankruptcy in the first quarter, which happens to be the largest amount since 2010. I mean, for the most part, corporations did take advantage of the low interest rate environment in 2020 and 2021 to refinance their debts. And as borrowing costs have increased over the last 12 months, corporations have been largely avoiding accessing markets given the higher borrowing costs. Meaning the drought in new credit issuance is illustrated in the next chart. An annual high yield bond issuance prior to the pandemic bonanza was within that $250 to $300 billion range. So companies were accessing markets because of very inexpensive rates. But if you look at the last year, it barely reached $100 billion, and that trend is deteriorating. Though we think that drought will eventually end, and corporations and if corporations need to borrow in a less accommodative environment when credit spreads are above average, it will allow credit investors to earn pretty attractive rates of return. We think banks are poised to kind of tighten credit requirements, and with more stringent standards, it will leave small and medium-sized borrowers without the same financing options that they had in the most recent past. We suspect this is likely happening today in U.S. regional markets, and we think that it presents an opportunity for non-traditional lenders. Again, private credit is an alternative strategy. It does come with an elevated level of risk tied to defaults and counterparties, but investors also have to be able to tolerate the lower liquidity that comes with non-traditional fixed income. Nonetheless, we think that an effective strategy would be able to generate superior returns compared to traditional fixed income markets, and also with less correlation to bond returns. Now, before I touch on my last topic on alternative artificial intelligence, Kathleen has our second polling questions, which I'll let her talk to.
Sure. The second polling question here that I'm just about to launch, and I'll read it just because I know it doesn't show up on our recording. The questions we're asking to you, our listeners, are: how do you anticipate AI to affect the management of your investment portfolio in the future? We've got some options for you here: optimizing your portfolio mix and weightings, assisting portfolio managers with fundamental analysis. 3, integrating artificial intelligence to better manage the diversification of your portfolio. 4, more alternative choices to traditional investment management. 5, all of the above. 6, other. So I'm watching everybody continue to vote, and I'll give you a few extra minutes here just to see. All right, I'm going to end the poll here, and I will share the results. And we'll see what Frank sees to this, but certainly, so 1, optimizing your mix and weightings, we got a 0% for that. Looks like the most was number 5, was all of the above. 53% chose that. 6, there's some other ideas that some of you are thinking about. You could always share those in the Q&A, and we can share them with the group afterwards. And 2, assisting portfolio managers with fundamental analysis. Some of you, 20%, thought about that. And number 3, 13% on integrating artificial intelligence to better manage diversification and risk management. So that's interesting. I don't know what you think about that Frank?
Well, I mean, obviously, AI has been on in the news a great deal, and I'm not surprised that people believe that it could have multiple impacts on how portfolios are managed. So that's probably what my selection would have been as well. So I'm not surprised at all. So I mean that's we want to touch on our last topic, which is the emergence of generative artificial intelligence technologies such as ChatGPT, and the potential impact AI could have on automating tasks and driving significant productivity gains. Since ChatGPT's launch late last year, AI has obviously attracted a great deal of attention, and there's been a flurry of reports on the potential impact it could potentially have on society. We think the rapid reaction from governments globally eager to set regulation to deal with AI speaks to the potential of the technology. In simple terms, ChatGPT and other alternatives in the space allow you to have human-like conversations with a chatbot. So in the workforce, the technology will provide companies with the ability to automate tasks and work processes that will, today are largely dependent on human interactions. For example, chatbots are and can be incorporated in workflows to deal with administrative tasks such as processing orders, servicing client inquiries, or generating reports. And what's interesting is that in a research report published by Goldman Sachs last month, they estimate that 2/3 of current jobs in North America and Europe are exposed to some degree of AI automation, and that generative AI could replace up to 1 in 4 current jobs. So these are very preliminary estimates. They're assumptions that they're based on AI technologies being capable of automating tasks and those AI being adopted by industry. But nonetheless, I mean, the estimates from Goldman in this report estimate that on a global basis, generative AI could expose 300 million full-time jobs to automation. As you can see from this chart, there's a lot of tasks related to administrative, legal, and financial jobs that could be replicated with the use of AI. And we recognize this is still an emerging technology, and its impact might fall short of some of these forecasts. Nonetheless, we find it fascinating how disruptive AI could be on how we work today and how it shapes our world. I think most interesting in the Goldman report, there's an estimate that generative AI could increase U.S. labor productivity by 1.5% per annum over a 10-year period. And if you look at the next chart, also from the Goldman report, it aggregates similar academic studies that have also concluded fairly meaningful productivity gains ranging from 1.7% to 6.8%. So from a macroeconomic perspective, workers displaced from AI innovation will become reemployed in new occupations that emerge from AI. However, that transition may not be totally frictionless. So it has implication on inflation, consumer spending, and a range of other factors, which speaks to why we've had so many governments kind of get involved and want to have a say in how AI is deployed. In terms of financial markets, there's undoubtedly going to be winners and losers from AI if it proves to be a true disruptor. From our perspective, we'll continue to follow the progress being made, and we'll look to our sub-advisors to identify how AI impacts portfolio holdings in our portfolios as we speak, but also seek opportunities how we could benefit from this very transformative technology. I mean, those were my insights, and I'm going to pass it back to Kathleen for questions.
Yeah, no, that's great. I'm going to ask Krista and to turn on her video. I think we've all got it on, and we'll have some Q&A. I think we have some questions that have come up throughout the presentation. And I'll thank you guys for, really interesting, insightful, presentations. I found it very fascinating myself. So thank you for that. I appreciate it. So here I will start with a question here. I think this one goes to you, Krista, or we'll start with you anyway. the question is there any danger that recent developments in the US banking sector may affect the Canadian banks in the next 12 months? In other words, do we need to worry or be cautious about holding the big 6 Canadian banks?
Mhm. I mean, I think one of the things that came across to us during that concerning period in the US regional banking is how much stronger our banking system really is. I think Canadian banks have stronger regulation and higher capital requirements. And I think, we feel pretty confident about our banking system. I think, all banks will have to watch the impact of these rising rates on their assets versus their liabilities. But I think the Canadian banks are very well capitalized and regulated. And personally, I think if we, because we have few strong banks, if one of the banks went under, we would have a bigger problem. It would be like having the government go under or something. So I feel quite comfortable having the banks. I think it's good. You can see some difference in how the banks have performed. A few of the banks have regional US regional banking exposure, and that's impacted a little bit the performance of those banks. But overall, I feel very comfortable owning the Canadian banks going forward. Frank, you have more experience. You worked at one of the banks. I don't know if you want to add anything.
No, I share your outlook, Krista. I think the banks are to first and foremost well capitalized. I think what's happened in the US has been a bit of a warning shot. So I think regulators are far more aware and making sure that the banking system is healthy and well capitalized. So I'm not terribly concerned about the Canadian banks.
Oh, that's terrific. No, and that's a relief. Thank you. Another question we have here, and this one sounds tricky. I'll read it out. The increase in rates has reduced the value of long duration bonds and mortgages. I heard that if all mortgages on US banks' balance sheets were marked to market, it would wipe out their equity. Is this a concern? And if so, would you reduce this sector's weighting in your balanced portfolio?
I think that's interesting. That's really getting to what happened with Silicon Valley Bank, which was, the fact that there is something in US accounting standards or global accounting standards for banks that if you have assets, you can have them as HTM, which is held to maturity. You don't have to mark them to market every day. With Silicon Valley, they had these short-term liabilities because they had cash deposits that people could ask for every day. And so maybe they hadn't yet marked to market these long bonds they had, but they actually had to sell the bonds to satisfy the deposits that they were paying out. So they had actual losses. So in that case, they needed to mark to market certain assets. I think when you think about the banks overall, you need to think about that matching of their liabilities and their assets. So to the extent that you've got banks that have very diversified deposit bases and they're not going to be drawn on really quickly, or they have mortgages in the US that they've given to other people that aren't going to be paid out quickly, et cetera. If you've got longer duration liabilities, then I think it's okay not to mark to market the assets. We've already seen some improvement in rates, and if you had to market in the middle of last year when things were really tough, you would have caused panic that wasn't required. So I think that combination of strategies makes sense. The bigger question then is, how do we feel about the sector overall, given that there are some risks with the assets? I think it's important that the banks are really paying attention to that and try to understand. We don't have direct exposure to the regional banks in our portfolios, and we're glad that we don't have that. But I think, it doesn't mean you wouldn't have it at all. We did talk to all the managers we work with and really tried to get an understanding about whether we had any exposure. I'm not concerned about having some exposure to the global banking system overall. I think diversification is important, not having all your eggs in one basket, and then really trying to understand if you do have exposure in that sector, understanding if there is that mismatch, because that's where, if there's short-term liabilities funded by long-term assets, then that's where the problem came in. So I don't think that we should force everybody to go into an everyday mark to market, because you'd have too much volatility that isn't required. On the other hand, that question highlights the exposure that exists in the sector. So I think important to have an idea. I probably wouldn't be heavily exposed to the regional banks, but I think also having diversification and being comfortable that overall the banking sector is okay. I don't know if you want to add to that, Frank.
No, I think you've captured the key points that I would reiterate.
Thanks for that. That's very interesting. I have a couple other questions. We have a couple more minutes, so I'll go forward. And if there's any other questions, this question: given the possibility of a new normal of higher interest rates in the future, how should this affect our expectation of overall investment returns during this period going forward?
Mhm. I mean, I guess to me, there's a couple of factors, and maybe you can jump in, Frank. I mean, I think on the one hand, we're seeing some better returns on cash and bonds. So the yield is a little bit better. We sort of didn't want to be in those positions a couple of years ago when we got zero return in those asset classes. But on the other hand, higher interest for longer could impact company costs and earnings impact for equity. So we got to keep an eye on that too. So I think it makes us more comfortable continuing to have a balanced portfolio with having bonds and cash to balance your equities, and you just need to really understand it. But I also, when I mentioned having a bit higher for longer, I'm not thinking that we're going to have, double-digit interest rates or anything. Just we may not go back to zero. So I think it doesn't need to throw out your strategy. It just might impact the fact that you're comfortable having a balanced portfolio again.
Yeah, no, that makes sense. I have one here, Frank. I'll direct to you. But Krista can jump in too. It's just because it's about AI. Given the importance of AI, how do you think this might affect your personal approach as a portfolio manager in the near future? How might that affect how you're adjusting?
Obviously it could have meaningful impact on how we work. I mean, obviously it's another tool, right? It provides us with another tool that we can involve in our process to in our work, in our interaction with some advisors, and understanding the markets and understanding sentiment, having access to all this data and generating ideas from such tools. So I think that it's still early days, but we're seeing we do work with some managers that are using AI. Maybe not to the extent that we've seen with ChatGPT, but obviously they use data far more in their investment process. So I think we're going to be using generative AI as part of our process going forward. To what extent, I don't know. But I mean, the early signs is that it's a pretty powerful tool for us to kind of integrate in our work processes, whether that be as a portfolio manager or other professions where you're accessing and working with information data.
Yeah, no, that's very interesting. I don't know if you want to add anything on that, Krista, on the
No,
AI
I think
story.
there's lots to digest, and I think that Goldman report was very interesting, and it's interesting to consider the many ways that we'll have to take that into account in future assessments.
Yeah, no, that makes a lot of sense. So I think we have one last question, and I think it's a good one to end on for both of you. Looking forward to 2023, what are in a short sentences, I guess, what are your biggest concerns and opportunities as we sort of close out today's webinar? It sounds like a good place to end.
I mean, I think some of them we talked about in the session that I think, we are moving in the right direction. So I think in the big picture, we are seeing inflation coming down. We're getting closer to the end of interest rates. We're moving in the right direction. We will see some volatility along the way. So I think we shouldn't be concerned to see that. We should stick with our plan and go forward. I think it'll be nice as I think what's nice is to actually think beyond this next little period of volatility. I think we'll see volatility, but generally in the right direction. And then going forward, there are some opportunities when you start thinking about AI and you start thinking about a transition to a green economy and you start thinking about infrastructure and providing capital. If you have capital, making money on that when the banks aren't always providing loans. I think those are the kinds of things to look at as opportunities going forward. But in the meantime, stick with a balanced portfolio that'll ride the waves through this continued volatility.
No, that makes sense. Frank,
Yeah, no, I just think that, we've had a pretty significant change in interest rates in the last 12 months. And I think we still have to assess how that really impacts the economy. It takes time. There's a lag effect, and that lag effect will, I think, present risks and opportunities. And that's what I'm watching most interesting. Obviously, we had Silicon Valley Bank as an example in the first quarter. And I think that we'll have other experiences in different parts of the economy that will show that higher interest rates are going to have some degree of impact.
Yeah, no, That makes a lot of sense. Well, I think I'm just looking at the time here. I think that's all the time we have for questions. I want to thank everybody for listening to our webinar. I want to thank specifically Krista and Frank for your very interesting insight and your answers to the questions. Just for all of the people on the webinar today, there will be a follow-up email. And we'll be including access to the recording of the webinar as well as brief survey. And if ever you have any additional questions, please don't hesitate to reach out to us or to your advisor. Thanks so much, everybody.
Thank you. Have a
Thank
good
you.
day.
Have a great day.
Bye-bye.